find patterns, and I love watching how the markets work.
Yeah, that's what I love about it too, man.
Yeah, I love watching it play out as well. Like when you chart something up and it plays out, it's just like, yeah,
It's
something
sexy.
else.
It's pretty addictive.
Yeah.
How long have you been trading with Donny? Because Donny obviously guided you through all this and first what to do and what not to
Probably
do.
a year and a bit.
Sorry?
Probably just a year and a bit with Donny.
Okay.
Yeah.
And would you say that that's sort of been a big reason to your success, or?
Yeah, for sure. I think Donny has like one of the major key roles for my success, you know, just like helping me through whether it's just little things to like a whole new style of trading. Like I've kind of took a lot of parts of the way Donny trades and incorporated it with the way I trade. So trading like supply and demand and order blocks and going for the big moves rather than catching the 30-40%, which I did for a while and I didn't mind. But because I didn't have a whole lot of time, trading those moves was just nice and simple. And I got a proper understanding of how markets actually run and work and the emotion behind them, the possible manipulation that occurs,
Yeah.
and really narrowing down my risk, big one as well.
Good man. Well done, mate. Like,
Thank
17 years old, that's inspiration to heaps of people, I promise you.
Yeah.
I love using Chris as an example because, so many people say that it's just too hard or they don't have the time and stuff. And it's like, man, there's a 16-year-old kid who learnt this stuff during BCE and has like absolutely nailed it. So any excuse someone throws at me, I just say, bullshit. All bullshit. And I was the same. I didn't really have time when I first started either. And I'd never really done any of this stuff to begin with. So yeah, a lot of the success stories we have are all people who probably thought they couldn't do it or didn't have the time to do it or didn't have enough money to do it. But most of the success stories are the ones who just stuck with it and just realized that it just takes time. Eventually you get there and you never look back, sort of thing. Or, when you do look back, you just think like, shit, I wish I had got in earlier. I wish I just had bit the bullet and just started learning this stuff earlier because like when I look at Chris, I'm like, shit, if I had started this stuff when I was 60, I think I'm 37, 38, something like that. If I had started when I was Chris's age, thinking where I'd be now, it's like, holy shit, how far I've come in 3 years to think, shit, if I had another 10 years on this, like, Jesus Christ. So yeah, I'm very envious of Chris, but he is a great example of what you can do in a very short time.
100%. You're going to do well, mate. Very, very well.
Thank you.
I think tonight, Dave, I was gonna jump into BitMEX. I just quickly set up an account then and just transferred some money over. So there's only $50 in there because it's all I had in my spare wallet. But it's something we can have a little dip with because mainly I leverage trade. So I mean, it's all good showing TradingView and showing different chart setups and stuff like that. But I just thought it'd be ideal to just jump in and show you guys exactly what I do. And, some of you guys probably never leveraged trade before and may not have ever looked at BitMEX. So I thought.
So for those that don't understand it, did you just want to give sort of a brief explanation on the difference between spot trading and leverage trading?
Yeah, sure. Should I bring up? I literally just finished another was an hour course just then explaining this to someone else. So I should be able to.
It should be fresh.
Yeah, I should be able to do it pretty easy. Can you guys see the whiteboard thing here? Yep, cool. So the easiest way to understand leverage because a lot of people just can't get their head around it. A lot of people leverage trade and still don't understand exactly what's going on. So what I'm going to do is put this into a bit of an analogy for you guys to make it a little bit easier to understand what's actually going on when you're leverage trading. I'll start off with an example of spot trading and leverage trading. So spot trading is essentially going on Binance and buying a coin. So what you're actually doing is you're actually buying that asset and you're holding that asset and then potentially selling it later for a profit or, sometimes selling it at a loss. So with a spot trade, for example, let's say you buy a coin here and it goes up and down and whatever it does, and then you sell it here and you make that profit. You've bought the asset, you're holding the asset, you now own it, and then you sell it. It's probably as close as you'll get to, say, the stock market. You buy shares, you own shares in a company, later on you sell it for a profit or potentially a loss. Now with leverage trading, you never actually hold the underlying asset. That's all done in the back end. And what you're doing is essentially the platform that you use, in this case BitMEX, is acting like a bank. And what you're doing is you're taking out a loan from the bank. Now, all this gets done in the back end, so you don't actually have to worry about applying for a loan and paying back with interest and stuff like that. It happens with a click of a button, but it's the easiest way to explain exactly what's going on is it's essentially a bank loan. So I'll just draw a picture now to just going to move this out of the way because it's really annoying where that is. Okay. So let's say, for example, we are going to open up a contract that's worth $1,000. Okay, so the contract is worth $1,000. We're buying a position that is worth $1,000. But what we're doing is we're actually borrowing that money off the bank, but the bank wants us to use some collateral, also a deposit as collateral. And let's say, for example, that's $100, okay? So we're using $100 of our own money to borrow $1,000. So essentially this $100 gets put over here as a deposit, and we're playing with this money. If we make profit, we pay the bank back their $1,000. We get our deposit back, and we get to keep the crumbs on whatever's left. If we made another $50, we get to keep that $50 as well. In the case of a short, same sort of deal. We're borrowing. Well, in the case of a short, we're borrowing Bitcoin, and you are selling the Bitcoin for dollars. The price of Bitcoin goes down. You then use that money you had to buy more Bitcoin, because obviously you're going to be able to buy more Bitcoin for the same amount of dollars. I'll show an example of that in a minute. And then you essentially pay the bank back the Bitcoin that you borrowed, and you get your deposit back and whatever's left over, whatever dollar value is left over. So what I'll do is there we go. Let's try and find the functions there. Bit funky on Zoom. That one there. So in the case of a long, we're going to borrow $1,000, right? And our leverage is, say, 10x. So what we're doing is we're borrowing 10 times our money to make up this contract. So in the case of $1,000, we're going to be using $10 of our own money, $100 of our own money, right, to borrow $1,000. If the price goes up to, let's say it goes up 50%, then that $1,000 position is actually going to turn into $1,500, okay, because it's gone up 50% in value. Once we close this trade, we give the bank back their $1,000, right? We get to keep the $500 that is left over, because that's our profit that we made. Okay, as long as the bank gets their $1,000 back, we get to keep the rest. Right? In the case of a short, what's actually happening is let's say we open up a short that's worth $1,000. Probably easy if we say 1 Bitcoin. If we borrow 1 Bitcoin off the bank and we sell it, we're going short. What's actually happening is, as soon as we open up a short position, we're selling that 1 Bitcoin for, say, $10,000. Okay, so now we've got $10,000 sitting on the sidelines. Now the price of Bitcoin drops, and it drops down to, say, $8,000. Okay, so now what we do is we use our $10,000 to buy as much Bitcoin as we possibly can. So we might end up with 1.2 Bitcoin. We give back the bank 1 Bitcoin because that's what we borrowed off them, and we get to keep the 0.2. Does that make sense to everybody? Sorry, I've got to find the chat and everything like that. Does that make sense? So you give back what you borrowed, and you get to keep the crumbs. Yeah, Milan, got it?
I can see Stephen's eyes lighting up.
So that's essentially what happens when we're shorting, longing and shorting. So you're borrowing money off the bank, you use your own money as collateral, and you get to keep the profit of whatever's left after you sell it. Sometimes you lose and you don't get your money back. So there is a downside to that. So here's the downside to spot trading and the downside to leverage trading. In a spot trade, you buy an asset here and the price goes down. Let's say, for example, you bought that asset there and it was worth $100, and then it goes down to here and now it's worth $90. You still own the asset and it's just worth $90 now. If later on the price of that asset goes back up and now it's worth $120, you've now got $120 worth of whatever this asset is. So spot trading, you can sort of go into a pretty big hole, but you'll still own the physical asset. And if it comes back, you make profit, you can exit and take your win. The downside with leverage trading, if you, let's say, for example, same sort of deal, we bought long, we took out a loan for $100 and we went long and the price came down. If it gets to a point of liquidation, which means you don't have enough equity left in your deposit, but basically you've lost so much that your deposit is not going to cover their loss, well then this contract gets closed. The bank takes your deposit. So your deposit would have been $10. The bank keeps your $10 deposit, which makes up because basically if you started with $100, by the time it gets down to here, it's only worth $90. They will close this trade. They'll keep your $10 deposit and then they'll get the other $90 left that's left, which makes up the $100. So they get their money back, but you walk away with nothing. So there's a big risk with leverage trading. If you get it really wrong, you lose your money. Whereas with spot trading, if you get it really wrong, you go into a bit of a hole, but you can always come back out of the hole, or you can choose to sell it at a loss. That's up to you. But with leverage trading, you don't often get that chance. If you get to a point of liquidation, you lose all your money and you don't get it back.
Well, just remember as well with spot trading, just because price was at a previous high, there's no guarantee that it's going to get back to that as well. So
that's true.
You might not always recover all of your money if you do go into a hole, but just keep that in mind too.
Yeah, you don't want to just sit there holding into a hole, assuming that it will go back to where it was, because it doesn't always work that way. And that's why we have things like invalidation and stop losses to make sure that we don't end up holding into a hole. At some stage, you've got to cut your loss and say, this is probably going to go a lot lower. Do I want to keep holding this asset into a really big hole? Or do I want to potentially cut my losses now, wait for this thing to fall in that hole, and then maybe jump back into that asset then? Because you'll find you'll probably end up with more of that coin or whatever that asset is in a much better position with much bigger upside. So yeah, never hold into a hole, which is why that's the hodler mindset is just keep holding and waiting for it to come back to where it was. And that doesn't always happen. So that's a big mindset or psychology shift that you'll have with trading, is when you start to realize that you've got to cut your losses sometimes and understand that you're wrong and have another go at it later. Don't keep holding on to it and being stubborn and saying, it's going to come back. It's going to come back. Because sometimes it just doesn't, or it might, but it might not come back as far as you want it to, or it might take 6 months. Do you want to sit in a hole with your money for 6 months waiting for it to come back to break even? Or do you want to cut your losses now and go and use that money to trade elsewhere and maybe make more money in the meantime? Or revisit it in 6 months' time and go, hey, it's a lot cheaper than it was when I got out. Maybe I'll jump back in now and I'll have more of those coins, which means if it does start to go up, I'm going to start instantly making profit on a lot more. But yeah, that's essentially sort of what's happening on the platform when you leverage trade. I will now I think that's BitMEX. I've got one account open here. So this is the BitMEX platform. It's been a while since I've used this account, but this is the trading platform that we see on BitMEX. Now, what I'm going to do is I'm just going to quickly reset this to show you guys what it will actually look like when you first set up an account on BitMEX. So when you first open BitMEX, it looks like this, which is pretty scattered, and it's kind of hard to see what's going on because there's boxes everywhere. You've got bugger all room here to chart on. You don't give a shit about any of this stuff. It's just a bit of a mess, but you can customize this, which is pretty handy. So what I would normally do is get rid of this, the recent trades. You don't really need to see the recent trades, so you can just cancel that. The depth chart's kind of useless on BitMEX because it's very heavily manipulated. So it's up and down, up and down. It's just pointless to look at. So we just close that because we don't need to know about it.
Don't worry about the reset, Stephen, because you'll adjust it yourself later, like Donny's showing you now.
Yep. So what I normally do is I like to extend that all the way. I don't need to look at any of this stuff. I keep all this out of the way, and I pretty much just have my open positions here. I normally make this a little bit smaller. Now, you don't always have to have order books. I don't use the order books to read the order books. I only have the order books there just to see where my order is, because sometimes I like to move my order around. Now, the idea of removing all that crap from the screen is because we want a nice big area to work with. We want a nice big area of the chart, because the chart's really what we want to be looking at. And then we're going to be interacting with our order book over here. Or this is where we place our orders. But really, we want as much chart space as possible. So that's why we customize our interface a little bit, just so that we've got a nice big space to work with. The other reason you want to make this big is when you first open up BitMEX and you've got this small little chart, you've actually got no trading tools, no charting tools. You can't see anything unless you make the chart big by pushing that maximum button. And then you've got your charting tools here. And what you can do is you can go in and click to make all your favorites. And once you've made your favorites list here, then when you make it small again, you'll have your favorites tool here so you can actually chart with. But if you just make the screen big like that, you'll get all your charting tools there anyway. So that's a little handy hint that you might want to use. Why is that? This is going crazy on me for a second then. So now we've got our nice big chart. We've got our tools. We've got our order book that we can look at, and we can see our open positions here, which we have none. Another real handy tip to keep in mind is when you first open BitMEX, for some reason, it's always defaulted to cross leverage, which is nasty. That's what you get caught out. Essentially what that's doing is using your entire account balance as margin. So if you end up in a hole, if you get to put a stop loss on and the trade goes bad, you can essentially lose your entire trading account. So what we try to say to people is stick to the isolated margin, which is essentially any of these numbers here. And you can do custom. You can click that button here and you can choose, 12x if you really wanted to. You can see here 12x leverage. But it's pretty handy just to stick with some basic numbers like 10x and just leave it at that. Now what this means is isolated margin means you'll only ever lose what you put in. So before how basically I was talking about having a loan, right? So when you have a loan of say $1,000 and it goes bad and you get liquidated, you lose your deposit. Now let's say for example, if it wasn't isolated and we're cross leverage, you can go into a deep hole to the point where your deposit gets eaten up and then the banks come knocking on your door asking for more money. And that's where they'll start taking this out, right? Obviously you can't lose any more than that, but essentially you're going to lose a lot more than what you put in and you don't want to do that. So ideally stick to isolated margin, which is just, sticking to these numbers here. Now to place an order, there's a few things you can do. I mean, you can just jump into market order. If you push the market order, you're just going to jump straight in. You're just going to buy at market, but you're going to pay a fee. And the fees are pretty nasty on BitMEX. When you're trading with large lot sizes, the fees get pretty nasty. When you're trading with a small amount of money, it doesn't really matter. 20 cents here, 27 cents there, it doesn't really matter. But when you start trading with big lot sizes, then it could be, 40, 50 bucks into a trade, 50, 60 bucks out of a trade. It's not something you really want to do. Bit of action at the moment, which is interesting. We might actually get some fun tonight.
Just about to say that looked prime.
We'll just jump in so we can see some price action. So I've just done a market buy there. So that's just virtually bought at market price, which is like the worst thing you can do because obviously you're going to pay a fee and you're going to buy at the shittest possible price, right? But we want to test. And sometimes when you're trying to show people and you're trying to do it live, there's no price action and you sit here with the fucking candle just sitting still. It's a real pain in the ass. So it's good that we got some price action. We can actually have a play. So what I always do is once I've put my order in, I want to protect myself. So straight away, I want to put my stop loss in, right? We go over to stop market. Now we've got 10 contracts open. So we're going to leave this on 10. And where do we want to put our stop loss? So we'll come through and go something like this and go, okay, I want to put my stop loss there, 11,289. So we go 11,289 and we'll push, before we push sell stop, what we're going to do is push close on trigger. Now what that does, that's basically telling the BitMEX engine that I only ever want this to reduce my position. I never want it to open more contracts. Because if you don't have that ticked and for whatever reason your contract gets closed before it hits your stop loss, when the price comes down and hits your stop loss, it'll actually open a short position. So you want to have close on trigger, which basically means it'll only ever reduce your position from 10 contracts. It'll never buy more, it'll never open more contracts. The next thing I want to do is I want to set my take profit. So let's say, for example, I want to put my take profit up here, 11,580. I'll go back over to limit order, 11,580. And same thing again, I'm going to press short and you can see here how we've got reduce only. Same sort of thing. It's only ever going to reduce my position. It'll never open more contracts. So I'll just whack that in now and then I'll show you as an example what could happen if we didn't have reduce only ticked. So if we didn't have reduce only ticked and that order was sitting up here, what could happen is if this price came down and clipped out my stop loss, that 10 would cancel out this 10. So essentially I've got no open contracts. However, this order is still in the book. So what could happen if the price comes up and hits here, all of a sudden it's going to open 10 contracts short. Okay. You might not want to have got into that trade. So that's like a really bad thing to do. So you don't want to leave orders in the book like that that are not set on close on trigger or reduce only, because all you're wanting to do is close your position with these two orders. You don't want to add any more. There is strategies to do it to add to your position, which is called position flipping, but most times you're not going to want to do that. Now, to do a position flip, what we'll do is we'll cancel that order. All right. And let's say, for example, just as an example, we assume that price is going to come up, hit this level, and then come down. Okay. So what we actually want to do here, we want to execute a take profit, which is essentially closing our trade, but we also instantly want to open another position and short it because we think that's what's going to happen. So what you can do is you can actually come up to here and go 20, right? But you've got to untick reduce only, and then we're going to go short. Okay. So now what this is going to do is as price comes up, that 20 is going to cancel out that 10, and then it's going to open another 10 short. So essentially we could sit back now and not have to worry about touching the computer. And if price comes up there, we know we're going to take profit and we're going to open a short, and then we're going to be trading it down again straight away. So it's a really good process. You can always automate your trades on BitMEX to a point where you can set up a trade and not actually have to look at the computer ever again. You know, like I can set this trade up now and I can take the day off. You know, you set alerts so you know what's going on, or you can, you know, get notifications to say that this has happened and that's happened in case you want to adjust something. But essentially I don't have to touch this. And I know whatever happens, I'm safe, because whatever happens, I'm either going to come down here and I'm going to close my trade for a small loss, or I'm going to come up here and take profit and then open up a short and come back down. It's kind of, it's not a win-win because this is potentially a loss, but it's kind of, it's either you're reducing your risk or you're making profit. And if you've already accepted the fact that you're willing to lose if it comes down here, well, you don't have to worry about this trade. It's going to play out and do its thing. So like I'm really big on that automation, and it's not automation as in bots and stuff, even though I have done a lot of bot trading. I've programmed a lot of robots and stuff like that to do things like this. But this automation process is more so just enabling you to not have to spend so much time in front of the screens. And it's more about the only time you actually have to spend in front of the screens is your setup. Once you've done your setup, you can walk away. There's no need to manage this trade or monitor this trade, especially if it's just a small trade that you're planning on getting in and out of, and you know won't really take that long to play out. You know, this could take 20 minutes, 30 minutes to play out. You're going to sit here for 30 minutes, like watching this thing like a hawk, or are you going to go play with your kids or make some dinner or something? Like, you don't have to sit here.
Everyone's going to sit there and watch it like a hawk to start with.
Oh, yeah. When you first start, it's addictive as hell, and you'll spend way too much time in front of the screens, which is not good. But, yeah, you don't have to. That's like when most people say, I don't have the time to trade. It's like, well, man, it takes 10 minutes to set a trade up. Not even. I could probably do it in bloody 25 seconds and then walk away from this computer and not have to worry about it. I can go to bed and know whatever's going to happen is going to happen. But I'm not going to lose any more than I've already sort of accepted, if that makes sense. So yeah, that's a really cool way to do that. Now I'm just going to close this and close that, and I'll show you how you can quickly close an order, because I want to show you a different way that we can buy. There's two ways to close this trade. If you push this button, what that's going to do is try and slide an order into the books, but virtually put an order into the books as a limit order. This does a few things. It possibly gets you a better exit, but it's mainly to make it sure that you are a market maker and you don't pay a fee. Instead, you actually get a rebate to close this trade. So if I push this button now, it's going to slide an order into the book, which means I'm applying liquidity to the platform. So they're going to reward me with a rebate if my order gets hit. So when my order gets closed, instead of paying a fee, I'll actually get paid a profit, essentially, for closing my trade. The other button, if you hit market, then that'll just close it straight away, but you'll be paying a market taker fee because you're taking liquidity out of the book to close this trade. So you'll pay a fee. The fees on a market taker is 0.075%, and the rebate for a maker is 0.025%. That's based on your entire position size. So again, it might not be that big of a deal if you've got a $10 trade or a $100 trade, but when you've got a $10,000 or a $100,000 trade, well, then that's like, you know, a $500 fee, which is pretty nasty. So what I'm going to show you now is I'm going to try and get a market maker order, which is sometimes a little bit hard when we've got a lot of price action, but sometimes it gets hit straight away. So we're going to press close, limit close, and that's slid an order. You can see where it slid that order just above the current price. And what we can do if it's a little bit far away, and this is why I like my order books, because I can see my order. You can see how it's bold. I know my order is, like what, 10 orders away from the current price. But what you can do is you can actually grab this and slide it down, and it will re-amend it. And you can see now I'm like second on the list, and you can get even cheekier and try and get it like right down. Oh, that's going to get hit if I do that. Oh, there we go. It's just moved again. So you can put that back there like that. And then of course it goes away on me. But yeah, you can end up following the price down a lot, but I just want to get this thing hit so we can show you. So it's right there. It's basically on the current price, eaten through the order book. Hopefully this gets hit in a second. It's going to be a pain in the ass. This is the worst thing about trying to do.
They can't see it. I can see it fine on my screen.
Oh, really?
Yeah.
What, they can't see the chart, the trade?
I'm not sure. Oh, no, hang on. Someone says all good. Yeah, I can see.
Yeah.
All good here. Simon can see. Maybe it's, yeah. I think he's going to exit and then come back. Sorry, don't keep going, mate.
All right. So this is the downside of trying to do a limit close. Sometimes it doesn't get hit. Price starts running away and you're like, oh my God, would you just hurry up and close? I'm going to lose more and more money. So if that's the case and you just want to get out of this trade, you can just cancel that and you can just press market, right? And it's going to just close it, but you're going to close at a shit price and you're going to pay a fee. That's the downside. But most of the times if you've bought in a shit spot, and it's going to go bad, sometimes you just need to cut your losses and get out of the trade. You don't want to sit there trying to like get a rebate of 2 cents or try and save it and try and get a little bit less of a loss. Like just get out of it and cut your losses. When you're wrong, you're wrong. What I want to show you now is a real tricky way that I use to get to avoid paying fees by using limit orders. So before, when I entered that trade, I just did market. I just did a $10 market order. Whereas if we do a limit order and put it, so for example, if we want to go long, we need the price, we need to put our limit order below. So we're just going to put it, say 400, like that, long. Now, post only means that you'll never execute at a market order. So just in case you accidentally put the wrong price in and it's going to be a market order, if you push post only, it'll never open the trade. It'll just cancel it. But in this case, we're putting it under the price. So it just does that. Actually, what I'll do is I'll show you if I accidentally did this wrong. So let's just say I accidentally typed in 11,440, which means we're actually going to be trying to buy limit here, but that won't work because that'll be a market. So what happens when I press buy? It just says submission error. Can't do that because I've got that ticked. So I've got to go through, put our price right, press buy, chuck our order in. Now that's a limit order. And again, we can move this around. If we want to chase the price, if we want to buy a little bit lower, you can just quickly grab it and move it around. All right. So that's all well and good, but you've got to sit there and type things in, and it can be a little bit of a pain in the ass sometimes. And if you find yourself trying to get that exact price, or if you're trying to slip an order straight into the book, if you try and type in 11,422, by the time you've typed it in, it's moved again and you've got to readjust the price, and it can be a real pain in the ass. So there's a little trick to this. And what you do is you press the little wheel up here, and there's a button that says show plus and minus button. All right. Now that's just put these buttons here. Now this is cool for a few things. If you want to increase your position size, you can just quickly press the plus 10 or the plus 100 and you can see your position size going up. So this avoids the need to like quickly sit there and try and type in the numbers. You can just quickly go bang, 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 or add a couple of 100 contracts or something like that. It's nice and quick and easy. And the other thing is, to adjust the price, same sort of deal. You can just sort of press the plus and minus buttons and adjust the price there rather than have to type it in. Now, when you say, well, let's just put in a price, say 11,460, right? Now, when I press market, it resets that limit order to be whatever the current price is, 11,414. You watch it again. If I change that to say 10,000 and whatever it is, 25, all right, that's where our current price is. If I press market, then limit, it goes back to the current price. So here's a cheeky way of doing it to try and slip an order into the book. right? We're going long, so we want to be under the current price. So you can press minus 50 cents. And what that's going to do is virtually slip an order in 50 cents under the current price. Now, if you do this fast enough, you can really slide an order in and try and be like top of the list, because you want to try and get your order filled, but you want to reduce fees. So what we do is we go market, limit, under by 50 cents, then press long, and then bang, buy. But you got to do it fairly fast. If there's a lot of price action, it moves really quickly. So what we do is we go market, limit, under 50 cents, buy, bang. The order's in the book, 50 cents under the current price. You've got the best chance of getting your order hit there than you do by typing a price in and then going, oh shit, it's moved. Type another price in, oh fuck, it's moved again. You know, you can sit there all day trying to get the right price, trying to get it 50 cents under the book just to get your order in. Whereas this is just four really quick clicks. 1, 2, 3, 4, and you're in. And yeah, you can see that's virtually just put the price in 50 cents under the current price. We might get a hit here soon. It's bouncing around a little bit. And what I'm going to do with this order is I'm going to put a trailing stop loss on as well and show you how you can set trailing stop losses so you can even less manage your trade. So just got to wait a little bit for this to hit.
Really eliminating that no time excuse, aren't you, Donny?
Yep. my whole strategy is based around not having to do shit. It's the best way to trade. You do a little bit and then you go and enjoy your day. Like at first, you're so addicted to the charts that all you do is trade, but eventually you just get over it. Eventually, you just want to just enjoy life. I'm just going to enter at market so we can get into this bloody thing. So trailing stop loss. So now what I'm going to do is, you know, we showed you before how you can set a stop loss in wherever you want to put your stop loss. But let's say, for example, you're happy with where you are and you're up in profit. You want to put a stop loss in to protect yourself, but you know, there's a good chance it might go higher. You just don't know where it's going to go. So what you can do is you can put a trailing stop loss in. And what this does, it acts like a one-way valve for your stop loss. So this price is set at $24 under the current price. You can change this to whatever you want. So let's say we change it to $35. Oh, sorry, I didn't do minus then. Minus 35. So what this is going to do is put our stop loss in. I'll just chuck it in now. $35 under the current price, which is fine. That's where we want our stop loss. But if the price starts to go back up, this stop loss is going to go up with it and always stay $35 under the current price. So right now, our stop loss is right here. And where we are sitting is right here. However, if we start to go up like this, why is it doing that? Have I got magnet on? No. Then this stop loss is also going to carry up like that, and it's going to follow the price. And then that way, if the price, you know, zooms up here, then our stop loss is also going to zoom up with it like that. And now all of a sudden our stop loss is in profit. And it keeps going, and it keeps walking up with it. Not until the price stops, turns around and comes back, and then it will go bam and hit your stop loss. Because your stop loss can move up with the price. It just can't move back down with the price. So like I said, it's like a one-way valve. It can go up, but it can't go down. And if you're in a short position and you set a trailing stop loss, then it can go down, but it can't go back up. So it's always securing profit. The lower the price goes or the higher the price goes, it's always securing that profit. So that's another really handy feature that you can use to automate your trading so that you don't actually have to sit there and watch it. I don't use trailing stop losses much anymore. I just don't need to with my style of trading. However, it has been quite handy in the past, especially when you say set an order and you're in profit and it's already well in profit that you don't know where it's going to go, but you know it could keep going. So you don't want to close your trade and you don't want to leave your stop loss down really low in case it goes, you know, here's a worst case scenario. You leave a stop loss here, price just absolutely moons up here out the screen, and then all of a sudden it comes all the way back like that, and you get stopped out here you're still in profit, but you look at it and go, shit, it did another 20% and I missed it and ended up coming back down here. Whereas if you had a trailing stop loss, you might have been stopped out here and you may have been able to, you know, snag an extra 15% or something like that. So it's really handy in those situations where you're already in profit and you're just hoping to catch that little bit extra after that. I really want to set this trailing stop loss to work.
You've only got 2 minutes of that candle left, and I'd
Yeah,
say
it looks like it might move a little bit. But I need it to go up a bit so you can watch the stop loss move. So we'll sit and watch it for a second.
I'd say once this 2 minute is this candle's finished, then probably have a bit of a bounce anyway.
Yeah. It's really hard to do demonstrations on BitMEX live because price action never goes where you want it to, and sometimes it doesn't move at all, and then it's just really hard to show people.
And I know that, like, when you're looking at it at the moment, guys, it's like, holy shit, like, this is way too much to handle, or it's very overwhelming. It is when you first look at it. I was exactly the same. Once you get used to it, it's pretty basic, really. It's pretty simple. The user interface could probably look a bit nicer, but it's not too bad. Have they got an app yet? They don't have an app yet, do they?
No.
I think that's why most people just spot trade on Binance, because it's so easy with the app.
It is, yeah. It's definitely a good spot to start and to learn. Like, I don't recommend leverage trading to anyone to begin with. Like, it's pretty daunting, and it's a very quick and easy way to lose money if you aren't a good trader yet.
Yeah.
So, like, if you haven't developed any good strategies, if you aren't good at TA, if you are shit at risk management and your psychology is nowhere near where it needs to be, leverage trading is the worst thing for you. You'll do shit. You'll make shit decisions. You'll get yourself into a hole. You'll lose a lot of money really, really fast. You'll start revenge trading because you're angry with yourself. It's so easy to lose money leverage trading if you just don't know what you're doing. So I don't recommend it to anyone to begin with. It's something you should really learn how to spot trade, get good at that, learn how to do your technical analysis, learn how to manage money, learn how to ride the ups and downs and go through the swings of the psychology and the emotion and everything that's attached to trading. And once you're actually getting good at that and positively making money and your account's growing, then you would start applying leverage to start profiting a lot more because, put it this way, like you can have a really, really good, strong winning strategy. You could be an absolute boss trader, but if you're trading with $1,000, it's going to take a long time before you actually start making some substantial amount of money. But if someone came and dropped $10,000 on your doorstep and said, hey, trade with this, well, then you can, and if you applied those exact same methods, you could start making a lot more money a lot quicker and potentially grow your account to a substantial amount that makes life a lot easier. And that's what leverage is, like literally the word leverage. You're leveraging your position. But you shouldn't do that until you get good at it, because not only are you leveraging your profit or potential profit, you're leveraging your potential losses as well. So just as easy as you can make money, you can lose money. Your losses are magnified as well. So that's why it's pretty dangerous for a lot of people who haven't really got their head around it, because you lose money way too quickly.
Look left, man. Where'd that candle close under?
I honestly haven't even been paying attention. No, nowhere significant.
Yeah.
Pretty much in the middle of this shit. Yeah, I wouldn't be surprised if we pull back to where the stop loss is. It might bounce on the 38 and push up from there. It is only on the small time frames.
On that topic, I suppose, while we're waiting to see what this next candle does, did you maybe want to explain to the guys where you set your stop losses and why?
Yeah.
Like in exact situation, for example, do you use a percentage method? Do you use...
No, I can't stand that. I don't like it when I see... It's a very, very bad habit when I see people using percentage stop losses. Like a lot of people say like, oh, I always have tight stop losses, or I always have a 2% stop loss. Everything I do is 2%. It's like, you can't have a fixed number on your stop loss. Your stop loss should always represent where I explain it as a battlefield, sometimes as a gridiron match or medieval battleground or whatever. But when we're talking bulls versus bears, you got to understand the charts is like a battlefield. It's an emotional battlefield. And what you got to think that, I think the gridiron term is probably the best way to do it. If you're thinking about an offense and a defense team, right? You've got to think of support is like your defense line, right? So let's say this is a defense line here. This is a level of support. That's your defense line. Your defense's job is to block, all right? Is to block the offense. So the Bears in this case, because you're assuming it's going up, so you're a bull at the moment. So the Bears are your attackers. They're coming down. You want your defense team to block them, and then hopefully you start pushing up. That's your last line of defense, because if your defense gets broken, you're going to get your QB sacked and you're fucked. You lose your money. All right. So if that happens, if your defense line breaks, you need to get out of the trade. This is no good. Your defense line's just broken. Your QB is about to get hit. You're about to lose all your money. Call it quits there. So what I like to do is look for those potential defense lines. All right. And the easiest way to look for defense lines is previous market structure. So what I'd be doing is looking at this line here, this low, and that low there is where my defense line should be. My defense line should be sitting here. I want to make sure my stop loss is just under my defense line, because you always get those wild wicks. You're always going to get someone reach through the defense trying to grab you. So you've got to make sure your stop loss is just below that. So in the case of this chart here, I would have put my stop loss under here, under this structure. There's probably a little bit too much shit on the screen now. I'll remove some of this shit. So essentially what I would have done is I would have put my stop loss probably about here, because that's my defense line, essentially that line there. So what I'm hoping is price will come down no lower than this and bounce off. But if it does have a little wick through, I'm still safe because I've got a little bit of a buffer. So I'm just standing a little bit away from my defense line. That is the ideal spot to put a stop loss. And whatever that percentage is, this entry was terrible, so it doesn't really matter, but 0.091%, I would then base my risk. If that was my entry, I would base my position size off whatever that stop loss is. So if that was a 0.91% stop loss, multiply it by the leverage you've got. So that makes it a 9% stop loss. I would make sure that if I lose 9% on this trade, it's going to equal 1% of my trading account. So if my trading account is $1,000 and 1% is $10, I'll make sure that if I get stopped out, I'm only going to lose $10 and no more. And that's sort of how you do a position sizing. Then you work out exactly how many contracts you can actually afford to buy. And to do that, you just go, well, if I'm going to lose $10 here, and we'll just call this a 1% stop loss, times 10, so it's 10x. So essentially you'd be buying, I just had a bit of a brain fart then. 100? Am I right there? No, it'll be 1,000. Yeah, you'd be buying 1,000 contracts with the potential of losing $10 at that stop loss. I think that's right. I do have a calculator for this. I built a calculator so I don't have to do this shit, which makes things a lot easier. But that's kind of how you do a position sizing. You work out the size of your stop loss, work out the size of your trading account, work out the percentage of that, and then that'll tell you exactly how much you should be purchasing on this order. This has taken forever. I don't think it wants to go up now. But really, that was probably like a really, really bad entry. What I really should have been doing is waiting for it to actually come back here and then looking for an entry. And then that would have meant my stop loss was much tighter, because I still want my stop loss to say be here. But if I entered here, well, then my stop loss is half as much as what it would be if I entered where I did. So we're talking about a 1% stop loss versus a 0.5% stop loss. So if my stop loss was half as small, essentially I can buy twice as many contracts. I think I'm about to get stopped out here. Does that make sense to people? If your stop loss is half the size, you can buy twice as many contracts and still be risking the same amount of money. Which is why you always try to get the best entry, because the best entry means you can have a tighter stop loss. So tight stop losses is a good thing, but tight stop losses in a weird spot is not good. If you're not really basing anything specific off where you're putting your stop loss other than saying, I want a tight stop loss, there's a good chance your stop loss is going to be nowhere significant and you'll probably get stopped out. And there's so many times, like when I'm teaching people, they'll say to me, I keep getting stopped out. I keep getting stopped out. And you'll look at their chart and their stop loss will just be the same silly thing all the time. And you're like, give your stop loss some more room, because they're doing their TA and what they see is right. They're sort of seeing something like that, but then they get into a trade here and then put their stop loss here. And it's like, but it's just, yes, sometimes my mind boggles. It's like, just give your stop loss some room and let it do its thing. Or try and get a better entry. If you saw it coming down here, why aren't you buying here? Why are you buying up here? Buy down here, and then you can have a nice tight stop loss if you want tight stop losses.
And that's why you don't FOMO in at resistance, guys.
Yeah. Never buy at resistance, never sell at support. Worst thing you can do. Just hit and put me out of my misery already, would you? Just trying.
Testing previous resistance.
Get it.
Oh,
Get it.
get it.
Just the tip. Look at the orders. Disappear. Back again. Oh, they're just playing with me. This is frustrating. We'll just close this. That's probably not going to get hit now, is it?
I wanted to see you get stopped out personally, but
I'm trying. Just do it that way. It's quicker. Now there's another way you can do it when you were trading breakouts, which is called buy stops and sell stops. So this is another good way to automate trades. So again, this is back to the whole automation, lazy, don't want to have to stand in front of the computer trading anymore. Let's just say, for example, you had a trend line like this, right? And in your mind, you're sort of saying that, okay, if we break this trend line and come out here, I want to open up a short position because I believe it's going to come down like this. But in order to trade a breakout, you have to sit here and watch this candle go and then break it and then jump in. You could be sitting here for hours waiting for that candle to break, only to find it doesn't break. And then you end up going, well, I just wasted 4 hours of the day waiting for this candle to do something and it didn't do it. It really piss you off. So what we can do is a thing called buy stop and sell stop. So essentially, let's say, for example, this is our trend line. Well, we're saying that, okay, if the candle comes out and hits this line, we want to jump into a short position. So what we can do is we come over to to our stop loss, and we do a stop limit. All right, but now what we want to do is we want to put this price, we're going to untick close on trigger and post only. We're going to open 10 contracts. And what we're going to do is we're going to put our stop price at 11,358. And then we want to put this price just a little bit under that just to ensure that it gets hit. And then we're going to push sell. All right, and what that's done, it's actually put a stop loss in here, right? But we don't have any open position. And because we've unticked close on trigger, that means it's not going to reduce. It's going to actually open a trade. So now we can walk away now and we don't have to watch this candle anymore. If this candle does break through and hits this level, then bam, we're in a short position. And we're going to start riding this trade down. That's if it does that, worst case scenario, it goes back up and you're just sitting in a shit position. That happens too, which is why I don't really like doing breakout strategies, but it does work. So that's a really cool way you can sort of set yourself up, again, walk away and not have to worry about it. And what you can even do if you really want to get a little bit silly, if you're thinking 50-50, say, for example, price is getting squeezed into a point and you don't know whether it's going to break up or you don't know whether it's going to break down, but you know the next move is quite harsh. It's quite fast. So there's going to be profit to be made. You just don't know which way it's going to go. So we can put a sell stop and we can put a buy stop. Let's put a buy stop in at 11,440. And we'll just change this price to 11,441. And we're going to buy. Right, now we've actually got a buy order and a sell order. So now whichever way it goes, we're going to be in a good trade, right? So if we pull down, bam, we're in a short and we're going to keep going down. If it pops up from here, bam, we're in a long and it keeps going up. You don't even have to, you can sit back and this will just do its thing. Now, I said that really easy, like that's like a no-brainer and it's a win-win situation. It's not really, because what can actually happen is we can come down and it can pull you into this short position. So now you're assuming that we're going to go down and then all of a sudden the price can come back up and hit this order. And what that's going to do is it's actually going to close this order in a small loss. Or vice versa, you can come up, hit this one, get into a long position, and then the price can come down and go bam, and you just lost. That happens too. All right, but that's the risk you take. And obviously you want to cover your risk by making sure you're making a good decision, but I'm just showing you that it is possible to do that. You can actually set a buy and a sell order either side of the price and walk away, and one of them is going to get hit. or both of them get hit, you know. But anyway, that's just another way to do it. Yep, cancel. I guess what I should quickly show you guys the difference between perpetual and futures as well. So we've been mucking around on the perpetual contracts on Bitcoin. So on BitMEX, you've got a fair few assets you can trade: Cardano, Bitcoin Cash, EOS, Ethereum, so on and so forth. Most of them just have futures contracts, but a couple of them have perpetual contracts as well. So what a perpetual swap contract is, it's virtually a leverage trading platform that is indexed on the Bitcoin price. So it uses a couple of exchanges to get the actual price of Bitcoin, and it doesn't stop. It's just 24/7. It constantly goes. However, you pay an interest rate every 8 hours. You pay a fee, or you get a rebate depending on what side of the trade you're on. And that's to pay the interest rates for the people who are lending to this platform. So if you were using perpetual contracts and you got yourself into a position and you're sitting in it for a couple of days, you're actually going to be paying fees every 8 hours. Every 8 hours, you pay another fee. The fees change. At the moment, you'll be paying a 0.01% fee if you're in the right way of your entire position size. So if you had $100 on, the fee is going to be 1 cent. It's not that big of a deal. If you had $1,000 on, it's going to be 10 cents. If you had $100,000 on, you're going to be paying $10 or something. You know, it changes. The interest rate fluctuates. So that's the downside of a perpetual contract. It's good because it's liquid, it's fast, there's plenty of volume, it's good and easy to get in and out of trades. The downside is if you're in a trade for a long period of time, you pay a lot of fees. Now with the futures contracts, it's virtually the same thing. Sometimes there's a slight fluctuation in the price, but it still mimics the price of Bitcoin. However, this doesn't have a constant fee attached to it. Instead, it has an end date. So the end date of this contract is September 25th. So at September 25th, if you're still in an open position, it'll automatically get closed and you'll pay a high fee, sort of like a late repayment fee. And doesn't matter whether you're in profit or loss, the trade will close and you're done. With Bitcoin, you've got the U20 at the moment, and then we've also got December 25th contracts, which is the Z20. So they're normally bi-monthly. They last for 3 months, I think it is, 2 months apart or something. So this one, you could get into a trade now and you've got up until December 25th to close this trade. You can still get in and out of this as many times as you want, but at the December 25th, this contract closes and the new one will open. So Bitcoin's got perpetual and 2 futures. Cardano has only got futures, right? 25th of September. Bitcoin Cash, perpetual and futures. Oh, what happened then? Shoot itself. EOS has only got futures. Ethereum's got perpetual futures, and it's got USD futures. Litecoin, they've just opened up perpetual and they've got futures. Tron's just futures. Ripple's got perpetual and futures now as well. Now, all the perpetual contracts, you'll see a XRP USD. So what it is, it's actually XRP versus USD. So you're actually trading the USD value of XRP here. However, when you're trading futures, it's actually XRP against BTC. So you're trading XRP BTC in SAT value. Same with Cardano. You know, on the futures contracts, it's ADA/BTC. So if you wanted to reference this, because obviously you don't get all the data because these contracts are only open for a couple of months, you don't get any data past when the contract opens. So if you wanted to look at much previous data to find like all new highs and all new lows, you've got to go on to say the Binance chart and look at ADA BTC. And that's what this chart's reflecting. However, you know, Bitcoin Cash perpetual is BTC, BCH USD. So it's tracking the USD price of Bitcoin Cash. Now Ethereum, they've done something funky with Ethereum. So they've always had perpetual with Ethereum, which is Ethereum/USD. And they've always had the futures, which is Ethereum/U20 or whatever the date is for that time. But what they've done is they've actually built futures USD. So what it is USD, ETH/USD, but in a futures contract. So it's a handy way you can trade ETH against USD, but without the funding fees every 8 hours. It's just a bi-monthly contract that closes at the end of the month. So it's kind of handy that they did that. It just adds, it's just another financial instrument that we can use to trade, which is pretty cool. But yeah, that's about it. Has that freaked anybody out?
It's excited some people.
Leverage, it can be pretty scary, but yeah, once you get the hang of it, it's like it's actually quite normal for me. I've actually recently just started spot trading again for the first time in ages because I'm teaching my partner to trade at the moment, and she's doing quite well. And I've just been starting her off on spot trading on Binance. So I've been having a little dabble myself, and it's brought back some memories. It's actually quite fun, and I realize how much more relaxing it is. It's so less stressful, just like buying some shit coins and just sitting on them and going, just wait, it'll come back. You know, probably bad habits, but yeah, it's so much less stressful.
I still do both.
Do you? Oh
Yeah.
man, I can't. I just every now and then I try. I like send a couple of grand to Binance to have a little play because someone's talking about something, and then I'm just like, I don't have time for this shit. It's too much.
And guys, if you get caught up in the whole Uniswap thing, just be super careful.
I honestly, I haven't even looked into Uniswap yet. What is it?
Basically, it's not an exchange. It's you swap your tokens because it's Ethereum based, so it's ERC20 tokens.
Yeah.
And you're swapping it directly from your wallet, so it's peer to peer. So if you use like MetaMask, for example, you're swapping it through the Uniswap system with another person's private wallet. So it's sort of cancelling out that middle. It's decentralized. So basically it's a DEX, but you can't put in orders. You can't set buy orders, sell orders, or anything like that. It's a swap
Straight
there and then at whatever the price.
Based on the price?
Yeah, it is. And the price, it's determined because what it is you can enter liquidity pools and then you get paid sort of a percentage of the pool every so often or something like that, from what I understand.
Geez, they make some shit, don't they?
Oh, and the way this one works, I think it's whatever the liquidity is, you get a percentage of it or something like that. And
they overcomplicate things that just aren't needed. It's like you got to think of what crypto is originally made for. It started off as like something that could solve a problem. Now they're creating problems and trying to fucking make things really difficult to solve. This isn't even a thing. We don't need this product.
It's 2017 all over again because anyone can list on Uniswap, right? So everyone's making all these, DeFi coins, DeFi tokens and listing them. And they're doing, 6, 7, sometimes up to 4,000% overnight. Like they're huge, huge percentages. The problem is people don't hear about them until it's already had its run.
Yeah.
The guys that are creating the coins or the tokens, they're the ones making all the buck because they hold all the tokens. They wait for people to FOMO in. They're selling at the top. By the time they're selling, everyone's only just hearing about it, So it's pretty dangerous. And not only that, if you do have a reputable coin on there, for example, Ethereum, I can go and create my own token and call it Ethereum. And then someone's buying my token that's worth nothing, but I'm getting all the money for it. You know what I mean?
Are you serious?
Yeah.
Why is this a thing? Why is everyone talking about this Uniswap like it's the next best thing? That sounds like a fucking scam.
It's throwing shit at a wall with blindfold on. Like people are making money out of it, but it's...
Let me guess, Uniswap has a token as well?
Hey?
I'm going to guess that Uniswap has a token as well?
I don't know. I wouldn't have a clue. I can only assume so.
Because it needs a token. Oh, God.
And the fees are huge. I mean, I think you have to approve to have the token accessible and you've got to pay a $6 fee or something. Yeah. And then every time you do a swap, which, it's either a buy or a sell, you're getting charged like up to $20 in gas.
What?
Yeah, $20 in gas. And for those that don't know, gas is like the Ethereum network's fees. It's huge fees, man. The Uniswap guys are making a mozza out of it. But, there's the people out there that are making money off it, but it's literally throwing shit at a wall. Like, I would advise staying away from it, but...
I've been seeing all the new DeFi stuff popping up. Like I'm big on DeFi. I actually partake in some of it, but more so the lending side of it. I lend my money out and earn interest on it. But I see it like I'm not into the whole buying DeFi coins because I understand the system and I understand how pointless the coins are. I make money on the interest by parking my stable coins and gold and stuff like that and earning interest on it while it's sitting there. But everyone's jumping on these DeFi coins as if they're going to be the next best thing. And it's like, oh, you twits.
Honestly, man, DeFi is the new 2017. Like it's absolutely
Yeah.
crazy.
Yeah. And they're just popping up left, right, and center. And most of them are just interfaces to interact with other DeFi systems as well. I'm like, you do realize this person or this group of people have just created a coin and an interface to interact with someone else's coin that was created. And they're going to give you these shit tokens. And it's just like, why are you buying this shit? I saw one of them the other day did a runner, Yam or some shit. And then another one popped up a couple minutes later, Yiffy or YFL or something.
Like 10 grand or something, dude.
Yeah, something like that. It's just like...
And that Yam one, I think that was a pump and dump, wasn't it? That was the rug pull.
Yeah, I don't know what it got to, but it literally went to zero. It's pretty funny. Like it's not funny. There's people who probably lost money in it, but you just think like, well, you're an idiot.
Honestly, if you're going to just throw money at something like that, then as harsh as it sounds, you probably deserve to lose it.
Yeah.
We've got a question here from Steve, man.
Yo.
Hey guys, if you have any other questions as well, chuck them in the chat box because I think we're pretty much winding down now, aren't we, Donny?
Yeah, man. Yeah. Donny, is there any chance that you could go over how to use percentage of your stop loss at 10x to work out how much you can enter? Yeah, sure, Stephen. Let's do that. What I'll actually do is so I built this calculator, which actually built this a while ago with a mate of mine, which really makes things a lot easier to work out position sizing. So virtually we click on margin trade because we're leverage trading. Click on BTC because it's easy to work out your BTC value. This is going to be a bit weird because there's not really a lot of money in this account, but let's just say we're going to start off with this 0.005 Bitcoin. We set our risk management plan, which 1% of your account, like you just said in that example there, Stefan. So let's just say we'll go back to Bitcoin. Now let's just say we did a trade setup. Say something like this. We're going to go long. All right, and that's our stop loss. Actually, we probably have to make it a little bit smaller. So 4.62. So we're typing our stop loss of 4.62. And our take profit, which doesn't really need to be known, but 17.7. All right, cost per contract. Well, the cost per Bitcoin contract. Oh, I'm on ETH, am I? My bad. Oh, well, let's say this was Bitcoin. The cost per contract is 0.001. So we go 0.0001, sorry. Max percentage margin loss is to do with your liquidation point. So we put it 50% so we don't lose too much. And now you can see our position size would be 10. And did I do this right? Yep. Position size would be 10. Leverage will be 10x. Margin capital that we'd be using on this trade is basically $1. And if we win, we're going to win $1.90. And if we lose, we're going to lose 50 cents, which is a risk to reward of 3.8 to 1. That's the easiest way to do it. But let's just say we had a little bit more money in our account. So let's say we had 130.135 Bitcoin. So you can see now it's telling us to buy 292 contracts at 10x. You just round it down, 10x. Margin capital, profit, $51, risk, $13. So it's a really nice, easy way to sort of work out your risk. And if you change your risk plan, let's change that to say 2. Now you can see we're actually buying 584 contracts. So we're almost doubling the amount of contracts. We're staying on 10x. We've got more capital. We're going to make more profit, but we're also going to lose more money as well. So that's the easiest way to sort of work it out using calculators and stuff. But there is some pretty basic math around it. It's been a while since I've actually had to work my math out myself because I've been relying on the calculator so much. But as an example, I'll just try and do it for you now. Let's say we've got $1,000 in our bank account. So 1% of that is going to be $10. So we're happy to lose $10. All right. So we look at our stop loss, and our stop loss is 4.62, and 4.62 has to be a loss of $10. So I don't remember how to do the math for this now. Oh God, it's been that long. I've been relying on this calculator for so long, and I've kind of gone blank. It could have something to do with staring at a screen for 5 or 6 hours. But
you need to go camping too, Donny.
Oh, I just need to get out of the house, man. It's a nightmare. I'm just going to
got access to that calculator, he said.
This one, no. This one's private that I built with a mate of mine, but we do have something we're going to release very soon that will most likely be out to the public. So 4.62, 46, and then times 10. Yeah, 462. Yeah, so you can virtually go $10 is how much you're willing to lose. Multiply that by 4.62, which is a stop loss, and then multiply that by the leverage, which is 10x, which gives us 462 contracts. Let's go back to say 46.2. If we were on 20x, we would be buying 924 contracts. So that's a nice, easy way to do it. So essentially what we'll be doing is buying, get rid of that. We'll be buying, was it 924 contracts or whatever it is here. And if it goes down to here, we'll technically lose $10 on 10x or 20x, I should say, sorry. That's kind of how it works. That's the simple, easy way to do the math.
Anyone else got any questions, guys? Just chuck it in the chat box if you do. Give it a minute or so.
Vince, yeah, so the calculator was something me and a mate of mine worked on Excel. Actually, I make everything in Excel. I've got a ton of different calculators and like position size calculators. I've got like journals that spit out all sorts of data. Because I do a lot of one-on-ones and stuff like that, let me just have a look and show you some. Whoops. I'm just about done. Where are we? Wrong one. Andy, Mark. So I do a lot of these sorts of trade journals for a lot of the guys I do one-on-ones with, right? And what it does, it's all drop-down menus. So let's say, for example, he was to open up a trade on, say, add a U20. It populates the date and time and everything like that. They let me know the kind of mood they're in, what the daily trend is doing, what the 4-hour trend is doing, what sort of pattern they can see, whether it's a bullish pennant, triple top, whatever they're seeing, what way they're going, whether they're long, short, or spot trade, the risk plan that they're using, so maybe 1.5, how long it'll, this is the risk to reward, sorry, so risk to reward maybe 2.21, how long they think this trade is going to take to play out, so 2-day, what type of trade strategy is it, breakout, level, range, continuation, so on and so forth. And then this is just like a confidence level on how confident they are with the trade. They'll key in a level here, then they post their chart in, and then virtually I get, so this is like a live journal. So as this student sort of does his, I get to go over it. So he'll show me his chart and I can generally offer him feedback and sort of see what he's doing. So he's doing a retracement trade here. He's looking at the pullback. So obviously he's seen, or you can actually, should be able to look at his notes here, holding a 38.2 as resistance. Lower high created, bearish market structure on the 4-hour, looking to trade back to the pivot lows. So he's obviously seen the 38.2 here. We're in a bearish market. Well, a current bearish sentiment. We obviously had a good retracement there, pulled down, made a lower low. This is now a lower high. So that's his entry. And as you can see, his stop loss is up above that previous high, just in case we do get a couple of those cheeky spikes. If this is the high, which looks like it could be, that might start to roll over down. So when did he do this? This was only a couple of days ago. So he hasn't updated it, but let's go and have a look and see how he went. So that was LTCU20. BitMEX LTC U20. Oh, sorry, I'm in the daily. I think he might have nailed it. So that was my chart from Monday. But if you look at his chart here, so he was looking to enter on that 38.2. So if I run fibs down from here to here, which is essentially basically here down to here, you can see he entered on the 38, but he had his stop loss above here on the 618, and then bam. So he nailed that. That was perfect. So he hasn't updated it yet, but when he does, he'll click that and say win, and he'll tell me how long it actually took to play out. And then he'll sort of put his P&L here. So how much profit and loss. You can see here he's had a couple of good wins here on a couple of these trades. That one was a loss. But the idea of this sort of journal, like this, the data that I collect, I then run graphs, and we can spit out a graph and compare things. So like we can check his P&L against like his win rate and see how often he wins trading a specific coin. Or I can see how often he wins when he trades a specific type of pattern, or what's his win rate pending his mood. You know, like he might have a really good win rate when he's calm, or he might have a really good win rate when he's long and can't short for shit. Once we identify all these patterns and try and find his strengths and weaknesses, then we can try and develop a trading plan or a strategy around what he's good at and what he's not good at. Sometimes if he's not good at something, we might need to work on it. So then I'll coach him on how to fix that. Whereas if there's something he's really good at, we'll harness that and work with it. Like if he's got a 90% win rate of trading breakouts going long, well, fuck, just do it, man. If you've got a moneymaker machine, just keep doing that. There's no point trying to fix something that ain't broke, you know? Like if you win 90% of the time doing this specific strategy, keep doing that. And you can literally print money. But, you know, most people do too much. They have way too many different strategies. They try different indicators. They try different time frames. They're just a mess. The idea of the way I do these coaching with the one-on-ones is we try to find out all the shit they're doing and try to condense it down into just what you really need to be sticking to. Because a lot of the time people find out that you try everything and you can never find out what works for you until you actually do post-analysis and start watching and analyzing and seeing what you are actually doing right and what you're doing wrong. And eventually you can condense it down into just sticking with the good shit, sticking what you're good at. But yeah, it's really handy doing the graphs and stuff on these because yeah, you really start to point things out. And it's really funny. You might actually find that like when I do cross-referencing, you might find that like you suck at trading Bitcoin. Like it's weird. Like you'll find these things out and you go, holy shit, like I lose 70% of my trades when I try to trade Bitcoin. Maybe I just suck at trading Bitcoin and I shouldn't do that. You know what I mean? Or maybe you might go, I want to get good at trading Bitcoin. Obviously, I suck at it. Where do I need to fix it? And then you can break it down into, you know, look at the graph, compare it to a few other things and go, okay, out of the 70% trades that I've lost on Bitcoin, 60% of them were shorts. Well, it's like, okay, well, how about I stop shorting Bitcoin and start longing Bitcoin and see if I can get my win rate back up, you know? There's so many things you can do with that post-analysis once you start doing it. So yeah, I love Excel is like incredible for building this shit. I build tons of different things for it. And yeah, me and my buddy who built the old one, we've built a new one, which is pretty sick, which does heaps more stuff.
Yeah,
so the old one used to just have basically you put your price in, you put the price of the contract, and it confused the hell out of a lot of people. But now we've built it, it's because it's using APIs, it pulls the data directly from the exchange. So as soon as you click the drop-down menu and select the coin you're trading, it'll actually update the price. So you don't actually have to fuck around with it. And if you key in the price you enter that, it works everything out for you. You can override the leverage in case you're doing different leverage than what it tells you to. It's actually really cool. But what we got to do is convert it from Excel into a HTML file so we can load it up onto the net. So it takes time, but we'll get there. Yeah.
Just had a question then. How do we get in on this? Guys, if you, after this call, because as you know, this is the third and final call, if you do want to learn more of this sort of stuff, just contact me directly via Facebook and we can get something sorted out for you. Is all right?
Yep, sure.
Any more questions?
No.
That's about it.
Cool.
Well, Donny,
I get to
man,
have a rest.
three free sessions for everyone. Like that's way more than anyone could have asked for, in my opinion. You've given us heaps of information to think about. So massive thanks again, man. I really appreciate you coming on and teaching some of these guys some things. Again, guys, this was something that I asked Donny to do because, you know, I had so many people reaching out to me when I started sharing charts. I was quite overwhelmed with the response. And, you know, Donny's the most successful trader in the crypto space that I know. So, you know, he's kind enough to come in, donate his time and help you guys out. So everyone say big thanks to Donny, and man, I appreciate it. And I'm sure we're going to see heaps more of you in the group. And like I said, guys, if you've got any more questions, reach out to myself. If you want to learn more of this stuff, reach out to myself, and yeah, we'll go from there.
Yep. Too easy.
Thanks again, mate. I really appreciate that, eh?
No worries, man. Yeah, I'm keen to do more of this stuff. I've got a pretty busy schedule at the moment, and we'll have a little bit of a break, but we'll revisit and do some more stuff soon. Try and revive the crypto den and get it pumping again like it once was. Yeah. I think 2017 scared a lot of people off, man.
Oh, 2017 got people in. 2018 scared everyone.
Yeah, sorry. Yeah, I should. Yeah, what happened after 2017 scared a lot of people off, which is unfortunate because I think there's enough of us who saw the potential and then got burnt and then said, this ain't for me. But the people who sort of saw the potential, got burnt and then said, okay, I need to get good at this. They're the ones who are still around and making good money. So like, I believe anyone can do this. Like I've taught thousands of students and I've seen hundreds of success stories. I've seen plenty of people come and go because they just don't have I would say the discipline and determination to actually want to do it. They're looking for an easy, quick cash grab, whatever, and they don't last. But there's plenty of success stories and they're always the same thing. It's just the people who had the discipline and the determination to actually get good at this. And I've seen so many different walks of life of people who have done this and been successful. Like we heard from Chris today, 16-year-old kid. Like anyone can do this. You don't have to be a rocket scientist. You don't have to have all this time on your hand.
And you've got the tools at your hands too. Like, you know, Donny just showed you 2 different Excel spreadsheets that pretty much work everything out for you. Like everything is available to you. You don't need a great deal of time, which Donny's really drilled into everyone's heads over the last 3 sessions. You've got everything you need there. So if you do want to be profitable and you do want to make this happen, it just takes a bit of dedication, investment of time, and just practice as well, I think.
Yeah, believe in yourself. You can do it. Anyone can do it.
Yeah, sweet. Cool, man. I got to go. Hey, young fella's heard his feet, so I've got to go and check on him. So I'll talk to you all later. Reach out if you need anything. Thanks, guys.
All right, guys. See you later.
Cheers.
Bye.